Welcome to the Investor Empowerment Series radio show, empowering your real estate investing with techniques, opportunities, and information, minus the BS and sales pitches. Now, please welcome the host of the Investor Empowerment Series, Joe Mueller, from the Tough as Nails Investment Syndicate. Joe Mueller.
All right, guys, we're back again. It's Joe Mueller with the Investor Empowerment Series radio show. Thank you for your feedback to some of my listeners here. Stu, you know who you are, complained that there's too much pop when I'm doing my podcast. So I'm using the pop filter on my mic that I've had since inception, but I really don't like using it. So it's just something I got to get used to. Awesome. That's better than nothing. So, guys, today we're going to talk about private money and hard money, just to kind of set the record straight on how private money works and how hard money works, so people have a better understanding when they're about to make an acquisition of what they can expect when they're dealing with either of those situations. And we're going to throw in a third one as well, which is business lines of credit. But to get started, you know, every investor needs to constantly be looking for money. That's the end of the story right there. You're constantly going to need to find sources to draw from if you want to continue to acquire properties and build your portfolios, or to continue to grow your fix and flip business. I've heard investors say that finding private money is easy, and I've heard the exact opposite, where they haven't been able to ever employ any type of private money. It is, in my opinion, the golden goose egg. Why do I say that? Well, the cool thing about private money, and let's get into the definition before I tell you why it's the golden goose egg. Private money is any source of funds you can use to acquire a property and fix it up that are going to be from individual to individual. So I'm Joe, and I borrow money from Bob. Bob lends me $100,000 to acquire a property in Chicago. I use that money to make the purchase, and perhaps he gives me the whole balance up front, or perhaps he gives me some of it through the process. There's different variations of it, which is why private money is the golden goose egg. And I've got all those funds for the acquisition as well as the rehab cost. So if I'm buying something at $75,000 and it needs $25,000 worth of work, maybe I'm getting a loan for somewhere between $80,000 and $100,000. Why do I say that again? I'm kind of bouncing my numbers around, because you can work out whatever type of deal you want with your private lender. Some lenders are going to feel more comfortable with you having more skin in the game, and maybe they're only going to give you 60% of the after repaired value of a property. Maybe they're going to give you 100% of the after repaired value of a property. Maybe they're going to give you the acquisition plus the rehab costs for whatever that project is. That's why private money can be incredibly powerful for investors, beginning, middle, and experienced investors. It doesn't matter, because it gives you that opportunity to see what you have available in your own business to access for funding, and then reach out to these various sources and pull together more funding to do the deal. As you grow as an investor, you're going to find that finding private money becomes easier over time. I say that because you're going to know more about your market. You're going to know about you're going to sound and know more what you're talking about. If you're focusing on Cincinnati, Ohio, just got back from that conference, by the way, so that's in my brain. Perhaps the average acquisition price you're working in is somewhere between $20,000 and $30,000, and each house needs $10,000 worth of work. So let's call it a $40,000 acquisition and rehab cost. When you've done it 3, 4, 5, 10 times, your numbers are going to be spot on. You're going to know exactly what your price ranges are. You're going to know how much it costs to fix most of these houses that are similar size, square footage. So until you digress into some type of a different type of project, your numbers are going to be roughly in the same ballpark if you're acquiring in the same areas, neighborhoods, cities, things like that. That's a very ambiguous statement, of course, because you got everything from multi-units down to condos, depending on where you're buying. But what I'm saying is, the more experience you have in whatever market or niche you're working in, the more likely you're going to be able to find private money, because you're going to be working with individuals in the area. You're going to be talking to people about what you're doing. You're going to be able to negotiate better based on what your expectations are for that particular project. So back to the golden goose egg. Why? I'll tell you right now. The beauty of it is you can be upfront and honest, which is always the best policy. Tell that lender what you need, what you're looking for. Be honest with your finances. Hey, I've got 2 other projects in process right now. I don't have enough funds to close on this third one, but it's a really great opportunity. Here's what I'm looking for. Here's what I need. Here's the rate I'm willing to pay. That's where the secret is, right? You can go to a broker, a mortgage broker, and get a loan for 4% on any Fannie or Freddie or FHA-backed type situation, hopefully as an investor. We're not going to get into how the mortgage brokering side works because I'm not an expert on that, and I typically am only using commercial lending and private and hard money. But, there are people out there that are able to acquire, 5 to 10 houses just off of those types of loans. Those are going to be the lowest rates, but they're also a lot more hoops to jump through. Those are the ones where you're going to need to have the water on. The utilities are going to have to be functional. The house is going to have to be habitable at the time when you're going to make that acquisition. Again, without getting into the details of the brokering side, the mortgage brokering business, W-2s, paycheck stubs, tax returns, et cetera, et cetera. And I'm not saying that those aren't needed in any type of lending situation, but what I am saying is they're scrutinized. I mean, you're going to be needing to prove to a bank that you've got X number of dollars coming in per month and you can afford that property. Fannie and Freddie and HUD have their own rules they need to follow on income levels and debt income ratios. That is income-based lending. That's what brokering is. And when I say that, that means how much money you make on your paycheck, as opposed to what we're talking about today, which is private money and hard money. That is asset-based lending. So let's make that clear for the listener. Asset-based lending means the borrower is an important piece of that transaction. The credentials of the borrower do matter, but what they're lending on is that opportunity. So if that property is purchased at 20% of its after repaired value, for example, which would be a smoking deal, they're lending that money based on the fact that that property is worth significantly more than what you're acquiring it for. Therefore, the loan is a lot more likely to get approved. Now let's go to the opposite end of that spectrum. Let's say the deal's really tight. You're making a purchase at $110,000. The property needs $15,000, $20,000 worth of work. Let's say the ARV on it's only $150,000. Is there still an opportunity there? Yeah, there could be, depending on what your exit strategy is. I think the numbers are pretty tight after you factor in a fix and flip cost of, roughly 10% for closing costs and brokerage fees and things like that. Now you're looking at a very small profit of maybe only $10,000 to $15,000. So that's one of the benefits of working with a hard money lender or a private lender on these asset-based opportunities, because they can also help stop you from making a decision that maybe you shouldn't have made. And when I say that, I guess what I want to elaborate on is the fact that they should be doing due diligence on their side. On the private money specific side, you may have relationships you develop where it's based on trusts and handshakes more than so much that property or your credibility per se, like the way a hard money loan would work. But it still should be factored in when you're dealing with a private money lender. So let's get more into that. So we talked about the definition of private money, what it is, and it's essentially relationship and asset-based lending. So when you've met a potential private lender, it's somebody that's got access to funding for your deals, and he or she is not going to be a bank. They may be a business. ABC Heating and Air might be sitting on $500,000 in a bank account, and they can lend you money. They're going to establish their own criteria on what they feel comfortable with when they're lending out that money. Maybe it's 7% and 2 points, for example. Maybe it's 10% and 2 points. The golden goose egg of private money is the fact you can negotiate a lot of those terms. And I'll give you an example. When you're sourcing your private money, or when someone like myself sources private money, I also look at the time factor. I'm considering the needs of the private lenders that I've worked with in the past or I want to work with in the future. So if it's a guy that maybe has capital ready to deploy immediately, but is a lot more leery of the exit strategy or wants to be a lot more hands-on with what the deal itself is, I'm considering that when I'm making my decision on who I might present an opportunity to, as opposed to, let's say, somebody that maybe is sitting on a pretty large nest egg and feels very comfortable with you because they've worked on projects with you in the past and they've been successful, and they might just be ready to cut the check immediately when you make the phone call. I try to keep those private money lenders we'll say, categorized to some degree. And I don't have, dozens and dozens, but when you're working with some, you develop a relationship, you got to maintain that relationship. You got to take into account what their goals are as well, because there's probably some type of income limit they're trying to achieve, whether it be passive or more active. Maybe they're doing multiple private money loans with multiple investors, which I've seen. Maybe it's a single individual who just has, $50,000 to work with, and they're looking for a lot more, we'll call it, quote unquote, attention to detail when you're working with them. So let's get into that a little bit. When you're developing these relationships, I'm guessing a lot of these questions are coming up in your head right now, like, how do you even start with these relationships? Where do you find these relationships? So let's talk about it. That is all about networking, talking to people, telling them what you do, handing out. This is simple business right now. I tell every new investor that walks through the door of my office, if they don't have a business card, get one, make one. Go on Vistaprint, go on Zazzle. We're talking like $20 for like 50 cards. You can design those things in 5 minutes. They don't have to be perfect. They just need the general information, name, phone number, and a little bit about what you do. I buy houses. That term has been floating around for years. Put it on your card. Maybe it seems a little corny. Maybe it doesn't. It's up to you to decide. I think there's value to it. That's going to spark a conversation. Maybe that conversation leads to more in-depth, discussion on, well, what exactly have you done or what are you looking to do? And you explain to that individual that you may meet, let's say at a networking group, exactly what you're looking for. And maybe that person is not your ideal private lender or doesn't become one, but they may know somebody. And you'd be surprised how quickly, once you start advocating for yourself, what you're doing and who you're working with, for example, on your projects, whether it be contractors, brokers, other investors that you've partnered with or you plan to partner with, that can establish a level of trust and create a situation where you're locking up private funding. I'll give you a couple examples of that. I developed a relationship years ago with a guy I met at a broker meeting out of state, and I've maintained a friendship with him for years. He knows who he is. He's out of Florida, and his partner as well. They just recently lent me money. I've spoken about it in the previous podcast. It was like snap of the fingers type deal, though. Never really talked to him about borrowing money from him, but we've established a relationship. He's always asked questions about what I'm up to in the Chicago area. I explained to him how I'm buying houses, I'm fixing them up, I'm typically renting them and refinancing them, growing a portfolio, as well as doing some fix and flips. I was at the sheriff's sale. An opportunity presented itself. I bid on a property, put down my 25% down cash, and guess what? Needed to come up with 75% of that balance within 24 hours. I made one phone call. I happened to call this guy as soon as I walked out of the auction, and I said, listen, I know we've never touched on this, one-on-one borrowing, working together on a project like this, but I need X number of dollars by tomorrow. I'm willing to pay this percentage rate. And I'll go through the deal real quick. I ended up paying a little bit higher percentage, at 12%, because I wanted access to that funding right away. They turned it around, and I had money back in my account within 24 hours, essentially funded that deal, no money down from the sheriff's sale, which is awesome. And now it created an even greater relationship because himself and his partner want to continue to work with me in the future. Thank you guys for that, by the way, if you're listening. That said, another way private money can be established. Everyone talks about bandit signs. Bandit signs, we buy houses. Bandit signs, fix and flip house, 1 block away, buy for cheap, needs work. I've seen bandit signs like that all over the place in Chicago. One of my good friends, Dan, who was on our previous podcast, number 4, and I believe number 4 and 5, he actually obtained a private lender through a bandit sign. The guy called in on a We Buy Houses sign because I believe he was selling a property. They ended up talking more in depth. Next thing you know, within a few weeks, Dan presents an opportunity to him, and he's got access to, we'll call it $100,000 or $150,000 in private funds that the guy lent him in order to do the deal. How awesome is that? So don't neglect to tell people, tell friends, tell family, tell everyone what you're doing in order to source that private money. I wouldn't be blatantly standing there asking for it per se, but if the opportunity arises where you can discuss what you do or what you're planning on doing, do it. There's no harm in that. And once you get through 1 or 2 of those deals, you're going to realize how happy and satisfied that those lenders are, that they're going to want to come back to you, and you can bring that into your conversations with future discussions. Like, yeah, I've got a lender I've used. He or she has been really happy with everything I've done. They've made 9% on their money over the last 12 months. And yeah, I'm thinking I need to diversify a little bit and just, do some more projects, and they're limited on the amount of access to money they have. So I'm only, I'd love to talk about how I can borrow some money from you. I mean, all those things need to be in the back of your head when you're meeting and shaking hands with people. Networking being a huge part of that, and developing relationships, expanding upon the relationships with your family and friends that you already have. So that's some about sourcing some of this private money that's out there. Now, where does it come from, aside from the person that has it? Great partners in private money are anyone who's got a self-directed IRA or self-directed 401k, anyone who's sitting on lump sums of cash in a bank, because they're typically nowadays getting 1% returns on their money. Same thing with anyone who's got a CD or some type of dormant retirement account. I mean, I'm not sure what the stock market's returning nowadays. I know with the recent Trump election, we had a dip on election day and a boom the days following after. But that said, typically they're averaging somewhere, between 4 and 7%. Well, if you can give them 8% twice a year, 6 months and 6 months via 2 private money loans, now they've got a 16% return on that money instead of 6 or 7 that they're used to seeing. Have those numbers in the back of your head. I wouldn't ask anyone, outright exactly what their income level is based on their retirement money, but maybe you need to, depending on what it is. Some people are too proud to admit that they haven't made their best decisions in the stock market, and you don't want to turn them off by, just blatantly asking them, well, what are you getting on your mutual fund portfolio? Some people don't like that. I can attest to that as well. I would understand that. So keep in mind, IRAs, CDs, bank accounts, 401ks. As far as the IRAs and the 401ks, they need to be self-directed in order for them to be able to access that money and lend on real estate. If they're in a regular type of IRA, they can transition it into a self-directed IRA. They would have to talk to their custodian as well as choose one that allows self-direction. So let's say they're in, ABC IRA company, who is just a standard IRA company, and they're just choosing mutual funds and getting a 4% return annually on their money, on let's say $100,000. They would need to choose a new custodian that allows self-direction. We'll call it, ABCD IRA company, and they may be a self-directed company. There's plenty of them out there. And they can guide that investor on how to transition that money into a self-directed IRA account. It's not hard. I've worked with investors to do it. Typically, it's phone calls and a few, some paperwork and some transferring of funds. It is not something that is complicated or scary as long as you're working with the right companies. So let's get into the nuts and bolts of private money now. After you've got somebody that potentially could lend it to you and has it in, let's say, a self-directed IRA account, you need to talk about the rate and the terms of how this is going to work, aside from the deal itself. So if you've got an opportunity you need access to funding for, be upfront and honest with that private lender on exactly what you're looking for. That's, in my opinion, the best policy. You don't want to be fudging any numbers. You don't want to be inflating any details. Be upfront and honest, including if they ask questions about your own personal finances at the time, because the deal should speak for itself. There's a long-term, or something I've heard for a long time in the real estate business, if you've got a deal, you'll find the money. I do believe that to be true. It may be more challenging if you're a newer investor because you don't have all the right connections, if you just started getting into this a month ago, but you will develop them over time as long as you keep at this. So depending on the needs of that private lender, like we talked about earlier, some people are looking for extraordinary returns, and other people are a little more passive and are happy to see a consistent, 8% return annually for their money when they know that they can work with you on the deal and they have a tangible asset. I think that's the key part. Instead of money sitting in some type of mutual fund account, they can actually drive past a property in your area and see that it's physically there. And let's be honest, if something goes wrong, what happens? They end up with that property, hypothetically. All depends on how you negotiate that deal. Typical rates are anywhere, I've heard as low as 6% for private money. I've heard as high as 12% for private money. It all depends on maybe the ease of accessing that funding, the knowledge you have of what, that private money investor's experience level, how comfortable they are with you, whether they've seen any of your previous projects, whether you've worked with them in the past. I would say, just like anything in life, the more you work with someone, the more you'll probably get, they'll develop a comfort level with you, and you'll be able to reduce that rate that you're paying on that private money. So typically it's simple interest, straight interest-only payments. You can make those payments monthly. You can make those payments as a lump sum when you close out your loan. It can be a 6-month loan. It can be a 12-month loan. That's the beauty, the golden goose egg of private money. You can negotiate those terms. So if you have a fix and flip project that you anticipate you're going to wrap up within, sold, at the closing table, cutting checks type stuff within 6 months, maybe you negotiate a deal at 9% for a 6-month turnaround. If you think this is a bigger project, or maybe it's one of your first ones and it might take a little bit longer because you're learning a little bit as you go, maybe you plan on 9 months to be safe, and maybe you pay a little bit more in interest. If you're just getting started, maybe you offer them 10 or 11%. I think that's fair. Now, there's probably some guys that have been doing this for years. They're going to laugh and be like, no way, I would never pay 11% for private money. I might as well just go hard money then. Yeah, that's true. But the key is the relationship. Establishing that comfort level with that private lender. Let them be a part of your acquisition, a part of that asset improvement process, so they can feel more comfortable and know that it's a safe bet when they go to invest with you again. Hugely important in this business. It is your reputation at stake. You can build in something called points into a private money loan. A point is essentially 1% of the loan balance that you're borrowing. So if you're borrowing $100,000 from a private money lender, 1 point would be $1,000. Points can be built in just as I'll call it just as an added bonus to that private money lender. You don't have to use points. They may ask for them. They may not. You may offer it. You may not. It's one of those things that's completely negotiable. There might be a private money lender that's been doing it for 30 years and says, I always charge 10% and 2 points. Okay. Now, again, you factor that into your decision-making process when you're evaluating your property or your project. If the asset's got enough meat on the bone and you're going to make a good chunk of change on it because you bought it you got a great buy price, maybe that deal would work out perfect for you. If things are a little leaner or you're not so sure of what the end result's going to be, you might want to negotiate that. Maybe want to eliminate those points if you can, or, again, work with that private money lender, make sure they understand. So I think we covered some of the basics of how private money can work, a little bit about sourcing it, how to work with other investors at networking groups and develop relationships with family and friends and tell them what you're doing. Like I said, have business cards, tell everyone that you're buying houses, mention that you're always using private funds or you plan to be, and why, and how your business strategy works. You got to have your plan in advance before you even get to that step. Hopefully you've listened to all my podcasts, and one of the first one or two we talked about developing your plan and having a business model set up. So if you want to be a fix and flipper, make sure you're explaining how you work up front so they are then developing that understanding of what they can expect when they lend you money. What if something goes wrong? Hey, crap happens, right? Sometimes it's your fault, sometimes it's not. Sometimes you open up walls and you realize you've got a bunch of shit in there you need to pull out and need to gut out a property that you weren't planning on it. You should be building in an overage into your budget for unforeseen circumstances, but let's pretend that you didn't. Let's say something went way wrong. You have to have an alternate exit strategy to benefit that private lender as well, whether it be they end up with the property or you're going to move it into a longer term hold situation instead of a fix and flip, and you're going to refinance them out. All those things need to be floating around in your head when you're negotiating, working with, and discussing things with your private lenders. That said, I want to talk a little bit more about hard money and a little bit more what the differences between private money and hard money. Hard money is similar to private money to some degree. It is also typically asset-based lending. So they're going to be looking more at the property and the opportunity as opposed to the borrower. So this is a great way to utilize money or get access to funding that when you may have some blighted credit situations in the past. That doesn't mean they won't ask for a cosigner or someone else to vouch for you in some capacity, or maybe they're going to charge you a little bit higher of a rate. Those things are realistic expectations when working with hard money. But it's asset-based lending as well. So they don't necessarily care if you're making $50,000 a year consistently for the last 3 years, like a typical mortgage broker would. They're going to care more about the deal and the fact that you're capable of turning that deal around and paying back that loan and making the payments that you've agreed to pay. Hard money rates are typically somewhere around the 12 to 14% range, at least in our area right now. I know of one large nationwide hard money lender that'll go as low as 10% and 2 points. But let's talk about that process and that rate a little bit. They often will have the capabilities of offering you larger lump sums of money. So you might be able to borrow as much as $1 million from one hard money lender. That could mean 2, 3, 5, or 6 projects going concurrently or one after another. You'll be able to close on a deal, close on a second deal to purchase the next day, for example, or run them concurrently while you're working on project number 1 and 2. You find a third deal, you call your hard money lender back, and now you're getting access to funding for your third deal. So you're keeping your ducks in a row like dominoes, right? You've got your plan in place. You're fix and flipping, or you're refinancing into rental portfolios. Doesn't really matter. It's just accessing that funding. You're paying a little bit more of that rate in order to get that access. So if you're paying 12 or 14% and 2 points, I wouldn't be surprised, but that's why, because they're offering you something that you typically wouldn't be able to find. I mean, who's got access to $1 million from a private money lender? A lot of people, a lot of experienced investors might have those opportunities. I know I don't. But, that doesn't mean that you can't get those additional funding options from a hard money lender. Maybe you use private money and hard money together, which I think is a great strategy. I'm sure there's a lot of us listening to this right now that have had an opportunity and used or accessed most of their funding available to themselves, and then a second opportunity presents itself that was just as good or even better than the first one. That's how that's how hard money can be an asset to you, because you might pay a little bit more, but if it gets you your next project lined up or, the next rental property in your portfolio, you need to have that as one of your options of your funding sources. So utilize multiple sources, I guess is what I'm saying. Now, the way hard money works differently than private money is a little more formalized. You're typically borrowing from a business or a company that specializes in, offering funding to real estate investors. We'll take a little side parentheses here. That doesn't mean that there aren't individuals out there that are offering hard money out there that are basically acting as a business, that are just operating independent of, just person-to-person type lending at hard money rates. Those exist as well. But typically, hard money is, there's larger firms out there. Sometimes they're localized to a certain city area or a state, and there's a few out there that go nationwide. As far as I know, there's one large lender that I've worked with in the past that I think covers like 42 states or something. So they're out there. Those business-type loans are going to require a little bit more detail on your side. You're going to have to fill out a formal application. They're probably going to want a personal financial statement. If they didn't, I'd be surprised. They're going to want to see some of your previous projects, not necessarily step in the front door, but they're going to see on paper, what other assets have you successfully transitioned into rental, or how many fix and flip projects have you done in the last 6 or 12 months? If the answer is 0 for you, that doesn't mean you can't still get money from them. That just means you have to be honest and upfront and say, hey, this is my first project. I've got the drive, I've studied, I've listened to Joe Mueller's Investor Empowerment Series radio podcast a ton, and he's totally awesome, and he helped me through this, and I can call him as a reference. All right, that's enough self-plugging. Sometimes what they're going to do, like I know hard money lenders in Chicago that say, okay, you've never done a deal, we're willing to lend you that money, but we need somebody to vouch for you. We need you to either take on a joint venture partner, or we need somebody with better credit, for example, if you're a little down in the dumps with your credit report, and have them co-sign with you, JV deals. So 50% of something is a lot better than 100% of nothing, right? So if you find an opportunity and you can't get the funding for it, and you go to a private hard money lender and they're not willing to do the deal without a partner on the deal that maybe has more experience than you, do it. So what? Like I said, you want to have something going. You got to get your experience somehow, and maybe you're better off working with a partner on your first couple deals if you're just getting started. And I know that that's one of the options. And how do you meet some of these individuals that can help JV with you? Geez, hello, I'm raising my hand right now. I mean, we're everywhere. If an investor comes to me with an opportunity and then doesn't have the funding for it, or can't get their hard money loan passed because they need somebody with experience, I'll do it. I'll help out. You can meet people like me at networking meetings. You can again, talk to other investors, start telling people what you want to do and what you're doing, and you're going to find those opportunities. I can't think of any investor that's been in this game for, any significant amount of time that's going to turn down a JV opportunity unless it's just too high risk. If the numbers don't work and they don't add up, yeah, maybe they won't. I could see that, of course. But that also means you shouldn't be doing that deal either if an experienced investor doesn't want to touch it. So let's go back to the hard money aspect again. You fill out an application. They're going to a personal financial statement. They're going to see a list of properties. They call it their REO schedule most of the time, which stands for real estate owned. You're going to fill out an Excel spreadsheet. You submit it to them. They might take a few days to review it. And they're going to come back and say, okay, yeah, we'll give you up to $500,000 at a rate of 13% and 2 points, for example. You can balk at those numbers. They're not ideal, but if you have the opportunity and you want to close it and get your business to the next level, that might be the only resource you can utilize in order to do that. So consider it as you're working through your options on how you're going to fund your deals. Hard money lenders almost always inspect/appraise the property. Could be both, could be one or the other, could be neither, I guess, hypothetically, but they're typically going to hire an appraiser to go out, verify the condition of the home, value it, and make sure that what you're telling them is accurate. Is there enough of a spread for this investor to make money on the deal and pay his hard money loan back? They need to verify that, and you're going to have to pay for that as well. You might have to pay an application fee of a couple $100. Then when you actually lock up your deal after they approve you, you're going to have to pay another $500 for an appraisal or an inspection fee. That is, maybe one of the income streams that they offer to keep their company in business. They might charge a little bit more than it costs to send an appraiser out there, but that's the cost of them spending the time on underwriting the deal and offering you that money. So that's part of the business. Once they approve the loan, typically they're able to close within, 10, 14 business days pretty quickly. If you're under the gun, you need to get something closed even quicker. Talk to whoever you're working with at a hard money lending company and tell them that, hey, man, I've got to get this closed like in 7 days. We need to put this into high gear. This is a great opportunity. I'm buying this property at a great discount. We can't lose this deal. And they should, if it's a good hard money lender, they should, all hands on deck try to accommodate your request. And there's no reason why it shouldn't work. One of the benefits of hard money lending, and I think we touched on it earlier, as opposed to using like a FHA loan, for example, or conventional lending, mortgage broker, is utilities don't need to be on. There doesn't need to be running water. The house can be condemned and uninhabitable, and they will still lend money on it because you've put together a plan to fix up that property and make it habitable again and fix and flip it, or refinance it, for example, and keep it in your rental portfolio. That's the last piece of the puzzle that I didn't mention about hard money is when you submit your asset, your opportunity for review so they can approve it, 123 Main Street, you get it under contract, you submit it to the hard money lender, they're going to want to see something called a scope of work. That is basically your nuts and bolts all the way to roofing shingles, description of exactly what work you're going to do and how much it's going to cost. So that's a key factor in this. It's essentially a bid from a contractor, right? I mean, you're allowed to manipulate those numbers if you want to add in additional repairs or increase the quality of the finishes you're using, but you need to have your contractors lined up and ready to go if you're going to be submitting to a hard money lender, or have a very good understanding of the construction side of the business. So when you price that stuff out and you turn it into your hard money lender, that's their expectation on what the costs are going to be. That's just how they work. And depending on how that hard money lender works, they may pay you that rehab cost in construction draws. So let's circle back real quick. You find that property at 123 Main Street and you're going to purchase it for $60,000. They may be willing to give you $40,000 on the acquisition side up front, but then you need another 20 or 30 to fix the place up, right? So you'd be in the whole project with acquisition and rehab for, let's say, $90,000, and it's worth $150 as an ARV value after repaired value when it's done. So if they're going to bring 40 to the table, you're going to have to come up with that $20,000 difference if you're buying at 60. It's fairly typical. They're going to want you to have some skin in the game. And again, I'm just giving you an arbitrary example here. And then once you've done the acquisition, you got to get work started, right? Some hard money lenders might give you funding up front to get started. A lot of them don't. A lot of them expect you to have some reserve. So if you do $10,000 worth of work, you're going to have to front that $10,000. So now you've expended $30,000 out of your personal funds, we'll call it, however you're obtaining that, which also could have been from a private money lender. And then they're going to send out another appraiser or an inspector of sorts to verify the work's been done according to the scope of work you've provided, right? So you've done electric, plumbing, and you've replaced windows. That cost you $10,000. They send a guy out. He snaps some photos. He walks through the property. He says, yep, every window's been replaced. The house is gutted out. I've got brand new copper and PVC plumbing, and I've got brand new piped electric throughout this property. They go back to the hard money lender. They send in their documentation. The hard money lender says, great. So you spend $10,000 on this? Yep. That's what I need. Okay, boom. They shoot you a check or they wire in the $10,000 you just spent. So now you've got another $10,000 to work with, if you understand how I'm explaining that. So that scope of work is very important when you're working with a hard money lender, because that's where they're going to base they call it a construction draw, but that's what you're going to base your construction draw off of, drawing more money back to you from that hard money lender. So you cannot just pencil whip up some type of a bid, even if you plan on doing all the work yourself, which is also fine. Most of the time, they're not going to care what contractor you're using, if any. But make sure your numbers are good, because if you've only got access to $10,000 in your personal funds to rehab this project, and you get stuck and you can't finish what you need to do, you're going to have to get another construction draw from the hard money lender. You're going to have to verify to them the amount of work that's done. If you overspend for some reason, or you jump the gun and repair something that wasn't in that order of the scope of work, for example, you might not get approved for the amount that you're asking for. Well, Joe, it says you were going to spend $10,000 on windows, plumbing, and electric, but then I see you ordered all the cabinets and granite, which are sitting in the garage, and you spend another $5,000. Well, we're only going to give you 10 because none of that stuff's in there. Yeah, okay, yeah, just material, right? I mean, that's the way that could potentially pan out. So, love talking about these subjects, honestly, because hard money and private money lending to me are fascinating. There's so much opportunity out there right now in order to obtain funding for deals that it allows anybody who wants to get started in real estate investing access to that cash opportunity to buy a property. Love to hear more from you guys. If you have any questions or comments, please get in touch with me. Send me an email. Reach out to me through the various podcast sources or YouTube or whatever. But for right now, that's all I got on hard money and private money. One more thing. Yesterday was Veterans Day, and I want to make a special announcement to all my family, friends, past and present, that were serving in any of our armed forces for this great country, as well as say special thanks to the police and firemen and civil servants who make this country a better place every day. All right. Take care.
Thanks for listening to another episode of the Investor Empowerment Series radio show. Be sure to tune in next week for another empowering episode. We welcome your feedback, so please rate us on iTunes and Stitcher, and visit us at www.investoремpowermentchicago.com or TannisGroupRealty.com.